Alright guys, this week, interesting subject, so get your comments in below. What we're going to be talking about this week is the difference between trading a futures market versus trading either on a spread bet or on a CFD account. And there's three real key differences here. The differences come down to what exactly you're trading, the information that you've got, and also the influence that you have. So let's start with what exactly are you trading. Now, with a futures market, you're trading the actual market. You're actually trading the product that other people trade that has an underlying asset. With a spread bet or a CFD, what you're trading is effectively a derivative of that. It's a synthetic product that allows you to bet on the outcome of something that is actually happening. Now, in the first instance, doesn't sound like a great deal of difference. But when you think about what exactly you're doing here, and this is what's really key. With a spread bet or a CFD, you are betting on price movement. You're betting that price will either go up or down. Now, with a futures trade, what you're doing is you're betting on the ability of price to move. And that's a distinct difference. The difference here being that if you're betting on price movement, you're looking at a level and you're saying, right, I think price is going to go up. Whereas if you're trading the actual market, what you're able to do here is you're able to say, right, I think price will go up if I see other people buying. And that's the distinct difference that you get here. That's the key element, that other people are trading a futures product, whereas you are just betting with a broker when you're trading on a spread bet or a CFD. And this also comes down to the question of information as well. All the information that you have when you're trading on a spread bet or a CFD is essentially a chart, and your edge is your ability to read a chart better than other people. And that's great, and you can gain an edge there. But what you don't have is the information, the flow of people trading. And this is where you're at a big disadvantage. Because if you're trading a futures market, you can see the flow of participation. You can see people actually trading. So your ability to read a chart is the same on both. However, you've got extra information if you're trading a futures market, because now you can see whether there is enough flow to actually make that move happen, rather than just simply a guess based on probability that price will go through that point or price will move away from it. And what you've also got to remember here, and this is really key, and this is where you have to remember that the broker has got a massive advantage over you. The broker can see the actual market, they can see the futures market, they can see what's actually going on. So you're trading blind against somebody who can actually see what's happening. And this is a huge disadvantage, because it means that they are able to take your side of the trade, or take the side of the trade against you, and also know whether they can get out. So they can influence the prices that they offer you. And this is the other difference as well. When you trade on a futures market, you're trading with everybody else who trades that market. So if I buy from one person, I can sell to another person. Whereas if I buy on a spread bet or a CFD account, I trade through that broker. The only person I can go back to if I want to sell is that broker, which again puts me at a disadvantage because they can see what's actually going on. So you pay the spread both ways there. And I'll illustrate this in just a moment. And the final other piece of or key difference between the two is that you have an influence on a market if you're trading futures, that you're not just betting on it, you can actually influence it. By you taking a trade, you become part of the flow. You become part of the movement within the market. So you have direct impact on what's actually happening. Whereas if you're just betting on it, you're a bystander. You're stepping back and betting on what those people are doing over there. Whereas if you're trading the actual market, you have an influence. You can impact price movement. So that's the key three differences between them. I'll go and illustrate this as well, and I'll show you what it looks like from a futures perspective and what it looks like from a spread bet perspective. So let's go and have a little look over at this. Now, what we've got here then is an image of the DAX future on the right hand side at the same point that we reached the level at 15,734 on the spread bet or CFD account on the left and the DAX future on the right. Now, if you're playing this as a break of the level, what you're going to be looking to do is you're going to be looking to buy 35s, break of level, and you're going to be looking for a move up, just move up towards recent highs around about 50s. So your level to break is 34. You're going to look to buy as it starts to trade into 35. Now, if you look at the spread bet account on the right, if you want to buy this, you're already paying 38. So that equivalent spread is 4 ticks compared to what you can try and get in the DAX, or 3 if you're going to pay 35. So you're effectively paying 3 or 4 ticks higher, 75 or 100 euros more to get into this trade. And that is a very, very significant amount. So that's where, to start with, you're at a disadvantage, because it's costing you a significant amount of this trade. If you're only looking for 15 ticks, you're giving away 20% of your trade, 3 as a percentage of 15, you're giving away 20% of your trade in getting into it. And likely, if we only reach as far as 50, you're also going to have to give away 20% in getting out. So you'll end up taking a trade where you get in at 38 and out perhaps at 46, 47. Whereas if you can buy on a futures, you're in at 35 and out at 50. The other thing that you're getting here is that the data, as it says in that chart image, is indicative. The data isn't giving you a point where you can actually trade. The data is just indicative, and the broker then presents their spread around this. So you've got a spread on the broker platform of 6 whole prices. On the futures, you have no spread at all. And that's quite significant, because at 25 euros per tick, 6 prices, 150 euros. That's a very significant difference. So ask yourself this as well. How exactly is the broker winning here? Quite simply, the broker's at a massive advantage because they can see liquidity and flow to start with. So they can see whether this is going to break. They can see if there's lots of people starting to buy in the DAX future, then they can then move their buy price to a higher point. So you may not be able to get 738, you may be paying 740 because they can see that the buying is coming in on the actual futures market. The other thing that they can do as well, and this is where the broker's happy to quote you prices, is that they can hedge. If you buy at 38, the broker is effectively short. So they're short at 38. Can you get out if you're short at 38? Absolutely. You can buy 35, 36 or 37, any of those prices, and the broker is winning. They've taken their trade. They've hedged the position. They're on a 3-tick winner, whatever happens here. And that's how a broker is winning in these situations. And this is where the distinct difference comes in terms of the information that you get when you're trading on a futures market compared to a spread bet or CFD, and also the cost to which you're paying to actually get into these trades. And it's a huge difference in terms of cost and information advantage that the broker has. And this is a crucial thing that you've got to try and realize. The one final thing that I've not talked about is the impact that you have on markets, the influence that you can have on a market moving. And this is crucial. You do not have influence if you're betting on the outcome of something. Be like betting on a sports game. I have no influence by betting on a football match because I am not participating in the football match. And a simple example of this is to think of a tug of war. If you're looking at a spread bet or a CFD platform, effectively what you're looking at is you're looking at the rope in the middle. And from that, you're then going to say, right, I think the side on the right is going to win. That's your bet that, the market's going up, for example. And you might be right, but you can't see who's on that side. For all you know, that side may have 10 people compared to 1 person on the other side. You don't know, but you're betting on which direction it's going to go on the information, essentially, of looking at the middle of the rope and the 2 hands on the end of it. Whereas if you're trading a futures market, not only can you have an opinion on which side is more likely to win based on the number of people one side or another, but on top of that, if you feel that the team on the right is going to win, not only can you bet on that happening, you can then go and join the end of the rope and help them pull, help them win, because you have an impact. By you buying, you are pushing the market further. And that's a huge advantage that you gain there. That it's not just the ability to say, I think it's going to go this way. It's the ability to, once it starts to go that way, then join in and actually improve the likelihood of it going that way. And that's a huge difference. This is the difference between trading on a spread bet or CFD account, trading on an actual futures market. Like I say, get your comments in. This is always a good subject. I'd love to hear people's comments on this. On that, whilst you're doing it, subscribe, hit the notification button, and you'll hear more videos like this. Spread bet or CFD account with a moving futures ladder, so you can see the direct correlation between the two, or the direct advantage that you're gaining from the futures market. I'll leave you there, guys. Have a wonderful rest of your day. I'll see you all very soon.